Hey there, David Pereira from Rent to Grow Homes. I'm the founder and renter-owned strategist here. And in this video, I'm going to be giving an overview of what potential investors need to know and what they should be asking as they evaluate rent-to-own investing. So the first thing we're going to do is define what is rent-to-own. I'm going to make my head a little bit smaller here. There we go. All right. So rent to own is a program. Rent to own is a general concept. It's been around for a while. I did not invent this. This has been around for a long time. Um, and what it's meant to do is to give people that have good jobs, good income, a path to becoming homeowners. This couple here could not qualify for a mortgage for a variety of reasons. One is the down payment. They didn't have enough. And two, they one of their credit scores needed to be improved a little bit. So this gives them the time that they're looking for to fix those issues so that when they go to reapply for a mortgage in 2 or 3 years, the banks will say yes this time. So we have our tenant buyers and then we have our investors. And the investors are the people who are buying the house today for this family and will be selling the house back to this family at a predetermined price, which is typically for a 3-year deal, it's about 15% higher. We assume 5% annual appreciation. So over the course of this deal, the way we structure this, the investor is going to receive 20% targeted annualized return. What that means is if the investor is in for 100,000 and I'm saying 20% annual return for 3 years, 3 years times 20 is 60%. So 60% of 100,000 is 60K in profit. So that is our target, that our investors will get 60K in profit over a 3-year deal if they're in for 100,000. In this particular deal, you can see the investors making 21% annualized ROI. Once we were able to run the numbers and get interest rates from the bank and figure out all the property tax and insurance, we were able to get 21%. So the numbers vary a little bit, but the minimum threshold is 20%. All right, so Rent to Grow Homes is basically my company. So we are a rent to own operator, and Rent to Grow Homes is kind of the brand for our company. So I've owned it, started in 2022, but I was an investor in 2020, and that's how I really kind of got involved with rent to own. So I've been doing this for quite a few years now. You can see a couple of the properties that are rent to owns. On this bottom one here, this family went through the entire cycle. They were the first ones we had that started and finished. And so now they are the owners of their home. And over the course of the last few years, I've been part of 15 rent-to-own deals. This is the first property I was ever involved with. So I was an investor. I was someone who had some money and this was like the beginning of COVID, and I just wanted more money to make some money with my money. But I didn't and I looked at a bunch of different models, and I'd read about rent to own, loved the win-win-win aspect of it, loved the fact that I get to help someone earn home ownership. But what I really enjoyed as an investor was that I got the same predictable monthly cash flow. In this case, was $400 a month. I never had to interact with the tenants. I did meet them the one time I went for the inspection when I bought the property. After that, did not need to go visit the property, did not need to speak to the tenants because there was an operator who dealt with all that. I never got a bill, an unexpected maintenance bill. All I had to worry about was the mortgage, property tax, and insurance. Everything else is the responsibility of the tenant buyer. And honestly, it was the easiest, most stress-free money I have ever had as a real estate investor. So that's what really turned me on into to rent-own investing. And so I decided to start Rent to Grow Homes so that I could bring more deals and kind of structure more stuff and be that person that makes more happen, just because I'm such a big fan of the concept. Like I said, it's a win-win-win scenario. So, and the reason it works is everyone wins, and no one is trying to maximize their profits. They're not trying to get the most possible. They all play a role in getting what they want. The tenant buyer gets a path to home ownership. They get structure. They get time to fix their credit, to build their equity, and they get certainty and predictability. They're not going to be evicted from their place. Their rent isn't going to go up. So they get what they're looking for. The investor gets a great return on their money. So like I said, at least 20% annualized returns. It's passive. It's transparent in the sense we have a spreadsheet that we keep updating. Once the deal goes through, we know all the numbers. So you know exactly what you're going to get each month, and it's the same amount, and you know exactly what you're going to get at the end. And there is a clear exit path. So this is not something where we have to kind of wait to see what the market does and pull the trigger on selling. We know this will be a 3-year deal or a 4-year deal, and that's exactly when we expect to exit. And there is something really purposeful and impactful about helping someone achieve their path to home ownership. And for realtors, for them, it's a point of differentiation. A lot of realtors don't understand rent to own. And they get to now give their clients an option. Their rental clients now have an option of something different, which is very attractive to realtors. So like I said, everybody wins in this scenario. So here is how we at Rent to Grow Homes, we execute our program. These are kind of like the major steps in the program. So the very first thing is qualification. I've been part now, as I've been a real estate investor for a long time, I've probably worked with maybe over 100 renters. And I've screened probably 1,000 through use of Google Forms and lots of just sort of quick scans. And you can sniff out when something's not quite right. I know that this program will work if I do my job at qualifying the tenant buyer well. So I spend a ton of time up front making sure we get the right kind of tenant buyers. And this means going through background checks, doing hard credit pulls on their credit score. My mortgage broker will go through all their paperwork, make sure everything sort of adds up and makes sense. So the very first thing before anything really happens is the qualification of the tenant buyer. I also have on the other side an investor who's getting pre-approved. So once the tenant buyer is approved and we give them a budget, then we know which investor would be interested in this deal with this budget, this location. Once we approve that tenant buyer, they work with the realtor to find the home. And that's an important key, right? So the tenant buyer is really invested in this home because they're the one choosing it. They're the one who's going to live there for the next 3 years and ultimately buy it. So it's important that they care about this property. Once we find a home that we like, we purchase it. So the investor agrees to purchase this home and agrees to sell it to the tenant buyer at a predetermined price. And like I said, we basically assume the market goes up 5% per year. So the investor purchases it and they own the home. During this 3-year term, the investor is the owner of the home. But the tenant buyer has skin in the game. We require at least $10,000 down, which they've had to put up front on day one. So there is reasons now for the tenant buyer to stick to the plan. Now, over this 3-year term, the tenant buyer they move into their home on day one. Each month, the tenant buyer is paying market rent and an extra amount for their future down payment. This extra savings amount will go to them in the future along with that original $10K. So now they'll have the proper down payment. We also provide them with credit support. I connect them with a credit coach, and they meet with this credit coach once or twice a year. And the whole point of this is to make sure their credit score is going in the right direction. Lastly, they own the home. So in 3 years, they've been saving more money. They've been working with their credit coach to improve their credit. So about a few months before that 3-year mark, we get them started in the home buying process. Make sure that the paperwork is all set up and everything is done through a legal transaction. They're already living in the home, but obviously now we have to have a sale from the investor to the buyer, to tenant buyer. And that's the last part of the process. So as you can see, we've really kind of structured this program with a few principles in mind. Number one, we're trying to minimize investor risk. Number two is we're trying to set our tenant buyer up for success. We want them to succeed. Because if they succeed, we all sort of make the money we're looking for. The investor gets paid by closing. Myself as an operator, the majority of my funds, the majority of my profit comes at the end as well. And of course, the tenant buyer gets a home, right? So we're all in it together to make this work. So here are some of the benefits of rent-to-own investing. There's a few kind of key things that stand out. Number one is the ROI. I've touched on this 20% annualized return. So over 3 years, that means 60%. It's truly passive. Up front, there's a bit of work to set up kind of making sure the payments are coming out, that you've connected with the city to say, hey, I own this property. The tenant buyer is going to be paying for the utilities. So I'll give you instructions. There's a little bit of work up front. Once kind of day one has happened, there's very little for you to do aside from cashing checks. Predictable cash flow. So every month on the 6th of the month is when I pay out the investors. So the investors will get everything to cover the mortgage, property tax, and insurance, and additional cash flow, which we've already calculated. For most of our clients, most of our investor clients, the cash flow ranges between $250 and $800. And it really depends on a deal by deal basis. It also depends whether the investor is looking more for income or they prefer to kind of have cap gains at the end. As I mentioned, there's truly a purpose here. It's easy to invest in anything, right? You could buy Bitcoin, you could buy stocks, you could buy ETFs, you could buy gold. There's plenty of ways to invest these days. This is one of the few ways to invest where you can actually see your money going to work and helping someone. You literally are helping a family earn home ownership, and there's a ton of gratitude that our tenant buyers express to our investors, either through notes through me. Sometimes there's a Christmas card sent or just a little quick note. I often go visit the tenant buyers and we'll take pictures and I'll share them with the investors. Investors are excited to see kind of how the family's doing, what they've done to the house. So there is something really altruistic about this entire arrangement. Risk managed. So all the prominent risks are managed and mitigated either through contracts. So we have a contract structure that really generally favors the investor. And then there's a very thorough process. And I'll go through an entire slide on risks later on in this presentation, but that's a huge part of this. And lastly, I mentioned the exit strategy. So there's a defined exit strategy, and usually the optimal exit's 3 to 4 years. On the right, you can see some of the reviews we have on our Google page. So I invite you to check that out. So what is the profile of a rent-to-own investor? What is someone who's a rent-to-own investor that we have today? What do they look like? So a lot of them are working professionals, wide age range, but they're busy. They're busy with work, busy with family, and they're really looking for something passive. They're not looking to manage tenants. They're not looking to place tenants. They don't want to go visit properties. They really often just say to me, hey, David, here's some money. Give me more money back in 3 years. The way that they're making their money now, though, is they're choosing predictable profit and low risk instead of maximum reward and profit, right? So there's always kind of this curve where the more risk, the more reward. In this particular case, we've mitigated a lot of the risks, but are still giving 20% annualized, which is great in any environment. Typically, the stock market is a 7 to 8% annual return, maybe up to 10 when you average things out and take into account inflation, whereas we're working at 20% annualized, and we've done a lot to lower the risk. A lot of our investors are concerned about the stock market today and the housing bubble in 2025. They may have some cash, but they're not excited about the uncertainty that's going on in the broader markets. Every time a politician speaks, things happen. So they're looking for a safer way to grow their wealth. Most of our investors have no properties. They've never invested before, or they may have one or two and they've had either good experiences. Sometimes it's been a bad experience. And they're like, you know what? Like, I just want this to be really simple. So this is a very good strategy for someone who's looking for simplicity and may not even have the experience or want another property management experience. Lastly, because they're buying the house on day one, the investor qualifies, right? So they need to have the 20% down payment. So they need to have that money, and that can come from a HELOC. It can come from savings, and they have to qualify for a mortgage. And all of our investors are getting mortgages from Tier A banks, right? So the RBCs, CIBC, TDs, all the usual suspects. So it's always 20% down with a Tier A bank. Let's shift over to the profile of a tenant buyer. So these are kind of our client who's going to be moving into the home. So they're often, like I said, a good family, good income, but they're getting rejected. And there's a lot of reasons that they fall into the situation where they get rejected. So one of them is immigration. There's something called the non-residential speculation tax, which means if you do not have your permanent resident status in Canada If you tried to buy a home, you would have to pay an additional 25% tax that gets refunded likely once you get your status. The problem is a lot of people don't have that kind of cash. If you're buying a $400,000 home, you literally need to have an extra 100,000, 25% to close. And that's just not feasible for a lot of people. So some of our clients actually use this, and while they're applying and hoping to get their resident status or their provincial nomination, they're using rent to own as sort of a way to circumvent that. And it's worth it to them because they get the predictability, they get to choose their house. There's a lot of benefits for them. That's exactly what this family did in the picture here. I've worked with a lot of families that are going through divorce or separation. Self-employed. Self-employed means that they are not a T4. They have their own companies. This often means they need to have 10% down. So they might need time to build up to 10% savings. A lot of people just don't have financial education. They don't understand the use of credit cards and how to use them properly. It just hasn't been taught well in school, as many of us know. And then if no one's really taught you those really good money habits, it's hard to develop them, especially when you're living paycheck to paycheck. And then things happen and you're not sure what to do. So I find that education is a big part of my job. Health issues. So someone gets sick. That often can sort of lead to a missed payment because they're preoccupied or they can't make payments because healthcare is costing them a lot of money. Temporary unemployment. Recent graduates, so they're early in their career, have not had time to build up a down payment, or they made a financial mistake years ago, right? So they were in a consumer proposal or even bankruptcy a long time ago. So there's lots of different reasons. And so these aren't bad people by any stretch. As I've kind of interviewed and talked to so many of these tenant buyers, they're not bad people. They're not stupid. Like none of that applies here. Like often I'm talking to people. They're really good people, good families, want good things for their children, but they've run into an issue, right? And sometimes it's a one-off, sometimes it took a bit of a period of time, but they're legitimate reasons. And if there's a legitimate reason that something happened, and as we do our due diligence on this family, we can see why things happened and why they're probably not going to repeat themselves again, then that's a family that I'm interested in helping. And so those are the kind of families that we do work with. All right, so what markets do we operate in? So what's really important to me is that we are in markets there's a reasonable chance of growing, both from a population and from an economic standpoint, right? So obviously in Ontario, there's a lot of immigration that's happening. That's driving rental prices. That's driving demand for a lot of things. I love anything along the 401, right? Anything where there's jobs, where there's transportation is a good thing in terms of growth. All the way from Windsor to London, Niagara Falls I'm fine with, all the way up to Kingston, Cornwall, Ottawa. The other thing that's very important to me is municipal infrastructure. I don't want to be dealing with wells or septic tanks. I want everything on the city infrastructure. Again, that's part of risk management. I don't want a $30,000 bill for a septic tank issue. So we try to keep things very, very simple. Now, as an investor, you don't need to live here. You just need to be comfortable that the property you're investing is going to be somewhere in this corridor. So I think one of the best ways to kind of have this come to life is to go through an example. So here is a family with 3 children. They've been long-term renters, and they would love to own a home. They've saved up $10,000 for a down payment, so they have $10,000 available on day one, and they want to purchase a place. And we've gone through sort of all their paperwork, and we've approved them for a budget today of $400,000. Now, this this agreed property value in 3 years, this is basically $400,000, and then you up that 5% per year for 3 years. That gets you to the 463 number. We mentioned the $10K down payment, and we know that we're going to need them to get to a higher number in the future. So in terms of the house price today, the house price is $400,000. The house price in 3 years' time we've agreed to is $463,000. So they're going to need 5% down, right? 5% of $500,000 is 5% of the $463,000 number is the $23,152. Then we add the land transfer tax, we add the legal costs. So our target savings for them, how much they're going to need to close, is $31,388. Now, if we already know that, we can work backwards and help them figure out what the monthly option savings credit should be. So let's fast forward now. So day one, like we said, it's 400,000 price today, 10K down payment. For the 36 months, they're going to have a monthly rent of 2,300 and a monthly option credit of 600, which means the total amount here is 2,900. Each month they're paying 2,900. And when we add the 10,000 to 36 months of paying 600 a month, that's 21,600. If I add this plus, if I add the 10,000 plus the 21,000, that gets me to 31,000. So again, this is the structure they need, right? If consistently they're paying market rent plus an extra 600 a month, they will get to their goal of having enough savings in 3 years. Often saving $20,000 is daunting, right? It's how do we do that? It's scary. But if you break it piece by piece, month by month, and just do 600 a month, you get there over time, right? And so this is how we get them to the $31,000 mark. Now let's shift to the investor perspective. All right, so like we said, the property was 400,000. The mortgage was 80%, so 320,000. The down payment, the 20% down was 80K. So the tenant buyer is in for 10,000. Then, so we subtract that, but then we add legal costs, land transfer tax, and I charge a fee up front of 4,000. So if I add all this up, the net investment from the investor is 80,000. Now I'm promising 20% target annualized return, and the target, which means over 3 years, that's 60%. So if I multiply 60 by 80, that's $48,000. So that is the profit that I'm targeting to deliver to my investor in this deal. Now, the payout model, from cash flow every month, I'm going to be paying off the expenses, so paying off the mortgage, property tax, the insurance with the money coming in. Then I'm giving the investor an additional $400 a month, which they can do whatever they want with. So there's $400 going to the investor every month for 36 months. If we multiply 400 by 36, that's 14,400. Then when we sell the house, we return the original $80,000 down payment to the investor. We know the target profit was 48,000. I've already given the investor 14,400, which means the profit from the sale of the house that goes to the investor is 33,600. And like I said, all these numbers were predetermined, right? On day one, we knew all this, nothing changed. So it's very easy to predict how much money needs to go to the investor over the course of the 3 years and then at the very end. So let's talk about risks now, because this is a really important thing. So far, I'm talking about 20% return, and there's always risks associated with any time the returns are that high. So here's what the risks are and how we manage them. Number one, tenant quality. So I mentioned earlier that this is a really critical step, right? And so we thoroughly vet the client, right? We look at their jobs, we look at their finances. So my mortgage broker is doing kind of a proper assessment of their finances. And it's also kind of what does their finance look like today, and what will it look like in 3 years? We're doing hard credit pulls and we're checking references. So all this happens before we approve them for the program, before anyone looks at a property. Another important detail is our tenants have an owner mindset instead of a renter mindset. They are absolutely invested in this property because they chose it. So they're going to live there. They're eventually going to raise their family there. They actually do care very much about this property. Whereas renters are often transient, right? So they're there for 12 months or 24 months, and then they go to the next place. So it's a very different mindset. The other thing I offer is a 4-month rental guarantee. So if for any reason the tenant buyer stops paying rent, I will cover that for 4 months. So it's completely uninterrupted to our investor. I will say I've never had to do that. It just hasn't come up yet, but if it ever were to happen, I'm happy to do that. Tenant qualification. So what this means is we want to make sure that our tenant is going to qualify for the mortgage at the end of their term, at the end of the 3-year deal. Now, if they can't qualify and it's their fault, so they weren't keeping up with their payments. They didn't raise their credit score like they should have. They didn't follow the instructions. So if it's something that's clearly their fault, they are at risk of losing up to 90% of that original down payment, that original 10,000, and all those saving credits that they've paid. Right? So if they walk away from the deal or they cannot qualify, that is their risk. And it's up to you, the investor, along with sort of my kind of guidance on how much of that we will withhold. But if that's the way the contract is stated, that's kind of the reality of it. Now, before they sign this contract, I spent a ton of time reviewing this with them so they understand what the risks are of them that they're entering. I encourage the tenant buyers to show the contract to a lawyer if they choose. I have no problem with that, but I want them to know what they're signing up for. And then the other thing we do about making sure them being qualified is I have that check with the credit counselor, right? So that forces them to stay on track. And the credit counselor can then let me know, hey, there's a problem. So this way we can nip it early and fix it rather than having to deal with it on month 36 when we're about to close a deal. Future appraisal price. So what happens if the market hasn't gone up and we cannot get an appraisal at our target price? So in our example, we had a price of $463,000 as our target price. If our appraisal is only $420 or $430, then we have a couple options. One is we can extend the deal for another year, or we can arrange for private financing for the outstanding amount. Now, let's assume the appraisal is the other way. The market took off and now the house is worth $600,000. Well, in that case, we still close at $463, and the investor still gets their 20% annual return, and the tenant buyer gets a great deal on a house. But that's just kind of the way it works, right? So the investor is in for predictability. They're not in to hope for a home run in terms of the house price going up. So the tenant buyer would benefit there, but again, the investor is still getting a great return. We manage location risk, right? So I mentioned focusing on tier 2, tier 3 cities, steady population growth, good job prospects, good economy. That's important because I want to make sure we also have positive cash flow. So I need to know that cash flow is possible with 20% down based on market rents and market prices. And I won't operate in markets where that's not possible. The other thing is in every location that I operate, I've got an established local team, right? So I've got relationships with realtors, home inspectors, and maintenance people if our tenant buyers need that. Lastly, the house or maintenance risks. So the property, whenever we make a purchase, we do it with a condition of inspection. And my inspectors know I'm looking to uncover the major issues within the next 5 years. I don't want any big expenses in those next 5 years. So once the inspection is done, I look at it, the tenant buyer looks at it, our investor looks at it, and if everyone's happy, then we move forward. We do visits, either myself or someone on my staff goes every 6 months to ensure the house is in good condition. The tenant is responsible for all minor maintenance. So if a toilet breaks or fridge or whatever small issue, that is on the responsibility of the tenant. They just deal with it on their own. If there's a major repair, so if, for example, the roof needs to be repaired, it's going to cost $15,000. What we would do is we would front the money. So either the investor or the investor and myself would front the money, and then the purchase price in the future would be upped by that much. So the investor would get their money back. But we know that tenant buyers are not going to have $15,000 available to fix a roof. So we make it work by doing it that way. Again, not something we ever had to do, but that's the plan if we needed to do it. So I've gone over examples, I've gone over the risks, I've kind of gone over the basics. So if this is something you're interested in, I invite you to check out our website at rentogrowhomes.com. There's a whole page there for investors. And I would say, maybe think about your investment preferences. Is there a budget you have in mind? Certain areas you're comfortable with? Are there certain tenant profiles that you like? And then determine your source of down payment funds. So is it a HELOC? Do you just have savings that you'd like to use, or a stock portfolio that you're not quite comfortable keeping in the markets right now? And if you are ready to take some action, then get in touch with me. My phone number is listed there, my email address as well, and I would be happy to chat with you. So hopefully this was helpful and would appreciate any feedback. Thank you.